Markets under pressure today after US GDP data pointed to growth slowing more than expected in the first quarter. Meanwhile, personal spending, a core inflation metric, rose more than expected. So, of course, these growing inflationary pressures could push out rate cuts, maybe to December in the United States. Remember, at the beginning of this year, markets were hoping for about half a dozen reductions in borrowing costs this year. We're joined by Earl Davis, Head of Fixed Income and Money Markets at BMO Global Asset Management. It's great to see you.
It's great to be here.
If we could focus in on Canada, does this create a real problem for the Bank of Canada? They'd like to cut interest rates, you say.
Yeah, it creates a significant problem for the Bank of Canada. And the reason is all the economic numbers we're getting out of the Bank of Canada point towards a cut. Yes, the Bank of Canada says they want confirmation, but they're leaning towards cutting. Having said that, we always have to remember that Canada is the wave, US is the tide. And the tide impacts the wave and everything else. And what do I mean by that? US yields are going higher, especially after today's data and the number. Canada yields are going higher behind that. And that impacts, that's part of the tide. So if the Bank of Canada eases while US yields are going higher, what happens? We get a significantly weaker currency, and that weaker currency adds to the inflation impulse. So they're in a very difficult position.
You'd be shooting yourself in the foot.
Yes.
Oh, my goodness. Talk to us about housing in Canada. You think it's going to stay fairly steady, given the fact that 5-year mortgage rates are down from the fall?
Yeah, so it'll stay steady. We've had a yield backup, or yields are higher. So your 5-year rate, which sets the mortgage rate from January, 60 basis points higher than it was at the beginning of the year, say 560-ish versus 5. Or 580, I should say, versus 520. But that is 60, or 480, sorry, versus 420. But getting my handles wrong with the US.
Yeah.
380 versus 320 in regards to the 5-year rate in Canada. But last October, that 380 was 440. So based upon last fall to now, the selling time for houses, mortgage rates are better. That's supportive of housing. And if the Bank of Canada does ease, that adds additional support to housing.
Do you see a risk still in Canada of a wage price spiral?
100%.
Wow.
And the reason why is because we still have 4+% wage increases. I think the last one could have been 4.7, the last employment number in regards to wage increase. The range the Bank of Canada would like to see is 2 to 3. That is significantly above that range. Having said that, it's going in the right direction. It used to be significantly higher in regards to wage inflation, but it's going in the right direction because of our immigration policy. We have more workers here. We have more supply of workers, and that's good to continue to get wage inflation lower. Having said that, if you get a weaker currency, prices in the grocery stores start going higher, people will continue to ask for higher wages.
But I thought we were getting inflation down in this country. So why is that risk of a spiral still there?
Well, we are getting inflation down. That's without a doubt. As the Bank of Canada says, we now have excess supply. There's more supply than demand, and that's why prices go down. There's 2 large impacts on inflation in Canada. One is excess demand versus excess supply, and that's good. That's pushing inflation lower. The other thing is imported costs. And if we have a weaker Canadian dollar, costs us more to import goods outside of Canada, and we have a lot of goods that we import. That impacts inflation. And that impacts inflation where people see it. Groceries, the store, goods. And that's why people will end up wanting and asking for more, despite unemployment going higher in Canada. But there is still demand for jobs.
We have a super open economy, don't we, compared to, say, America?
And that's why U.S. is the tide. We're super open, but we're super open to the U.S.
Yeah.
So the direction of rates in the U.S. ultimately has an impact here in regards to the decision-making process that the Bank of Canada and the governors are going through.
Talk to us about the States. Is Jay Powell feeling sick as a parrot, as they used to say in Britain?
Yes. So what I would say, we're at that cusp where not only may you reduce the amount of eases in the U.S. this year, there's a potential you could have hikes come in. And the reason why there's a potential in the U.S. that you could have hikes, I only put it at 25%, but that's still significant, is for 2 reasons. One is the consumer is still extremely resilient. Although growth, GDP, was lower today and much lower than expected, it's still positive. Still a lot of excess demand. And now we're starting to see the uptick in inflation. We saw the core quarter on quarter today. Tomorrow's a very, very big inflation print. PCE in the US is what the Fed looks at as their proxy for inflation. That will have a significant implications on monetary policy going forward is tomorrow's PCE number.
What do we get today?
Today, what happened is not necessarily what you got, it's what you get versus expectations. And the quarter on quarter surprised 0.3 of a percentage point higher. That is significant. It was 3.7 versus 3.4. So they're wondering now if tomorrow's print will surprise higher. And if it does, from a Fed's perspective, they have to say, oh, maybe we are too easy, or maybe we should be higher for longer at a minimum. And the next potential discussion is possibility of hikes, which you're seeing some Fed governors talk about.
Sorry, I'm a bit confused here, and I should have checked this out earlier. Did we get personal consumption expenditure numbers today, or what did we get today?
We get the quarter on quarter, the numbers that come out with GDP. The inflation numbers that come out with GDP,
I see.
Which are an indication and a leading indicator of the numbers we'll get tomorrow.
Sorry.
So that's exactly what we got today, and that's part of the reason why we're seeing this market reaction. We're seeing the whole yield curve in the U.S. go higher because they're saying, oh, maybe Fed policy is a bit too easy. 2-year bonds in the U.S. are now above 5%.
Oof. Yeah.
That's significant.